Welcome students who are taking Math for Business and Finance and Math Applications. In this set of videos, we are going to be discussing the theory portion of Chapter 18, which is on inventory and overhead. And as always, if you don't understand something, feel free to rewind the video and watch it again. And if you still don't understand, telephone and speak with an instructor or contact us via email. Chapter 18 here on inventory and overhead is going to be another one of these here dense chapters. Chapter 16 was a little bit difficult. There's a lot of information. Chapter 17 was on depreciation was relatively easy, but now we're back into inventory and overhead. And even though there's only 4 or 5 concepts to deal with, they are difficult. Well, it all depends upon your perspective, whether they're difficult or not. I know that out of the entire textbook, this is the chapter that gives students the most, that is the most difficult for them. We get the most amount of questions from this chapter, and that has to do with like the inventory method. So hopefully in watching these videos, it will make sense to you. And like I said, if it doesn't, call and speak with an instructor, okay? Right, so I don't know how many videos this is going to take for this chapter. Again, since I'm just winging stuff here, and I may not sure I set up the set up the slides with certain topics. I have a tendency more to just babble on with what comes into my mind, so it may take quite a few videos to get through this theory. All right, so let's see what we're going to cover in this set of videos. Okay. So as an overview, it's kind of like broken down, and just by the name of the chapter, we're talking about inventory, and we are talking about our overhead. And with inventory, it's basically about methods of valuation. In other words, how to determine what our inventory is worth, the different methods that we can use. I'm going to cover cost of goods sold and cost of goods available for sale as a broad overview idea, so that you understand in somewhat of a framework how they fit into this idea of inventory, and of course to get the terminology underneath your belt. But really, there's only 4 different methods of inventory valuation, and that's a specific ID, weighted average, FIFO, and LIFO. And then after that, we'll talk about overhead, and we'll talk about a retail method, a gross profit method, inventory turnover, and the distribution of overhead. So that's what these videos, however many it takes, will cover. And for right now, I'm going to move on to the cost of goods sold and cost of goods available for sale, and then I'll stop the video and kind of go over like one video each. Maybe the FIFO and LIFO together will be one video. It's hard to say. Explaining these two together makes sense, but then we'll see. We'll see when we get there. And then the overhead, probably each one will have their own separate video. So for right now, we'll just move on with the cost of goods sold and cost of goods available for sale, and then see where it takes us. Okay, so I have here, now if you noticed I had said cost of goods sold and cost of goods available for sale, but I switched them around and put the available for sale first, and then I also included gross profit. Right. So from to have a better idea as to what we're talking about here, in Chapter 16, when we were discussing financial statements, we had a balance sheet and we had the income statement. And on the balance sheet, we had inventory, what you're selling. Okay, and this is what we're talking about here is our inventory valuation methods. How do we value, and for this chapter anyway, how do we value that inventory method? But these statements are intertwined. Okay, you look at one and sure that presents a picture, but having the other helps to round out that picture. So even though we have an inventory on the balance sheet, what happens to our inventory is basically shown on our income statement because that's the operation of the business. For example, I can go out and I can buy a table for $100, okay? And I'm going to put that table into my inventory. Now, we're not talking about, in this video, I'm not talking about the valuation methods. I'm going to be discussing cost of goods available for sale, cost of goods sold, and gross profit. So right now, just as an example, we put $100 into the inventory. So our inventory value is $100. Now, what happens to a lot of people is when that table is sold, so we have our sales account, which goes on our income statement. When we sell that table, and let's say we sell it for $500, okay? Well, that shows up on our income statement when we make our entry. But our financial statements aren't correct because it's no longer in our inventory. Sure, we're showing the sale, but on our books, we haven't taken it out. So whenever you make a sale of something that is inventoried, you actually have to make two entries. You make one entry for the sale of the item, and then you have to make a second entry to take the item out of inventory, and it gets put to an account called cost of goods sold, right? So our inventory then would end up being 0 if we had sold that table, and over here we have our cost of goods sold. Okay, so we have sales, and then this would be less our cost of goods sold, which then gives us our gross profit. In this case here, we're talking about $400. Okay. Now remember, we're looking at the income statement right now, and remember on the income statement, basically it's revenues less expenses gives you a profit or loss. You've seen this before in the previous videos. Okay, but that doesn't help us for analysis purpose. And as you can see, right now we're talking about our revenue section because this here is all in revenue, all right? I could just say, I have $500, but now how much profit did I make on that table? Well, I made $400 profit on the sale of that table, and that's what the cost of goods sold is. And then, of course, from this $400 comes all of the rest of our expenses. They're generally titled selling and admin expenses. And however many they are, we're talking about things like payroll, utilities, advertising, etc. Okay, so when we take out all of these items, okay, that'll give us a total expense. And then the total expense, whatever those expenses are, has to come out of that gross profit, which then gives us our profit or loss. So that's the structure of the income statement, okay? But in this chapter here, we're specifically looking at, our inventory, which is directly related to our cost of goods sold, okay? Now, keep that framework, that idea in the back of your head as to how this income statement is set up, okay? Because for me, it always just seemed to help to understand these things. As I'm working through stuff, if I have the big picture in my mind, I know where to zoom in. If I'm talking about cost of goods sold, then I don't have to be messing around with like maybe down here I have a supplies expense, right? Well, that has, that has nothing to do with, cost of goods sold, right? So I don't have to concern myself with the expense section of the income statement, I can kind of just, you know, only zoom in on the revenue section of it and, you know, understand it from that perspective. Okay, so that's what cost of goods sold is. It's, you know, I buy something, in this case here, it was the table for $100. Okay, I buy that something for $100. Okay, and I put it into inventory. That's why it's called cost. That's my cost. Okay, and then of goods sold. Well, you know, of the goods sold is that table. That's why it's called cost of goods sold. Of goods sold, because it's the good I sold, and it was the cost of that. And of course, I want to know how much profit I'm making on the sale of that item, right? Because obviously, if I buy something for 100 and I sell it for 100, right, I make zero profit, all right, and I can't stay in business. Now, by having that, okay, we determine what our gross profit is. Now, what does this have to do with my goods available for sale? Okay, and this goes into, again, inventory valuation methods, but I just want to cover the concept of cost of goods available for sale, right? So let's say in my inventory, I already have $1,000 of items in my inventory. Okay, so that's my beginning inventory. Okay, now, depending upon the business, I mean, think about it. A grocery store, you know, when the store opens for business that day, there's a certain amount of inventory on the shelf, and that could be called my beginning inventory, right? But all day long, people are taking things and selling them, and, you know, removing one item is very difficult to do. So at the end of a period of time, we actually want to do a physical, PHYSIC, a physical inventory, in order to get to know what the value of that inventory is at that time, right? Excuse me. But in the meantime, you know, we're not doing a physical inventory every day. I mean, we might, you know, we start out at the beginning of the month with a beginning inventory of 1,000, and people are, you know, buying stuff off the shelves every day. But we also have to replenish that stuff on the shelves, so we make purchases. Okay. And so let's say I make a, you know, my first purchase, say a week later, and I buy $2,000 of more of inventory, and it's on the shelf. Now remember, some of that stuff is being sold, okay? But my books show that I have $3,000 at this point in time, okay? Again, during the say the course of the next week, you know, I'm selling more stuff, and I have to go out and buy more stuff, and say I buy $2,000 more dollars worth of stuff at that point in time, okay? So now my books are showing that I have $5,000 worth of goods that are available for sale. I mean, meaning I could sell them, and the key word is available, okay? It's the cost, which is what I'm paying for, of the goods that are available for sale. Now, I could have sold them, and maybe I didn't, all right? But my books are showing that I have $5,000 worth of goods available for sale. So where does that leave us? Well, you know, obviously during that period of time I'm selling stuff, so it's not on the shelf. And I know I don't have $5,000 worth of stuff in my store, okay? So that's why we do the physical inventory, right, in order to get an ending inventory amount. Okay? So when I go and I do that physical inventory, and let's say when I do it, I have $1,500 on my shelf. Okay, well that means that's my ending inventory, that $1,500. Okay, but that means I sold $3,500 worth of stuff during that period of time. Okay, that is my cost of my goods sold. Okay, so my books were, because I'm not making entries every single day, my books increased because I kept on making these purchases. But now all of a sudden I have to make an entry in my inventory in order to make sure that my inventory balance is correct. And whatever that entry is, in this case here it would be for $3,500, I have to move that over to my income statement under my cost of goods sold. Okay, and let me erase these numbers and give a little bit more realistic numbers. Okay, so my cost of goods sold for that period of time in the operation of my business is $3,500. And let's just say, I sold all of those items for a total of $4,250. So my gross profit on that inventory that I sold would have been $750. That's my gross profit. And then again, from this, I take out my expenses, and that leaves me with a profit or a loss. Okay, so the key things here to kind of take away as a quick recap is we have inventory, okay, and we're going to go over in the next videos how we create a valuation of the inventory, because there's different methods of doing it. Groceries on the in a store are handled differently from automobiles in a car dealership, which are handled differently from M&Ms at Hershey's, or candy bars at a Mars, factory. Okay, not all inventory is the same, so you have different methods to use. But we're going to cover inventory and their methods. And whenever we make sales, we had a cost for that inventory, and when we make a sale, yeah, we record that sale, but we have to move that cost over to our cost of goods sold to get the gross profit, all right, on the items that we sold, and then we take out everything else, all of our other expenses from that gross profit to know how much our profit or loss was for that period in time. Okay, remember, the income statement is the operation of the business for a period of time, right? Okay, so the other concept that we have is because we have different kinds of inventory items. It's one thing to say, okay, I buy a table and I sell a table, and that's my cost of goods sold. But in the case of a store, we're not going to buy a can of soup, and its cost is 50 cents, and we're selling it for 75. And during the course of the day, 10 people might buy 20 cans, and it just gets to be too much. So what we end up doing is we end up starting out with a beginning inventory, and then we add our purchases during that period of time, and then we take a physical inventory, and we end up with knowing what our ending inventory is. So the difference between everything that was available for sale, meaning what we originally started with, plus all of our purchases, is our cost of goods available for sale. Right? That's another concept that we need in order to be able to determine our cost of goods sold. Okay, so go back and watch this video again if you don't understand something, and if you're still a little bit confused, feel free to contact an instructor. Okay, but you'll see these concepts again in applications in the upcoming videos, so maybe it'll make more sense then. All right, but right now I wanted to give you an idea as to how everything fits together, and you'll see how it does come together by having this framework in your mind. All right, I'll see you in the next video when we're going to talk about the specific identification method as our first inventory valuation method.